everyone, welcome to our channel where we try to simplify the stock market for you. Let's focus on a topic that many traders seem to be fascinated with, options trading. Did you know that a recent SEBI report indicates that despite its popularity, just 10% of people make money trading in the futures and options segment? That's why Sharekhan recommends avoiding any casual approach and instead going in for a serious approach when it comes to trading in the futures and options segment. And since market participation of retail investors is highest in the options segment, this video will focus on this segment. First, we'll talk about some basic terms all traders should be aware of. And finally, we'll tell you how these help you develop the practice of conducting serious research before setting out on your trading journey. So come on, let's get started. As experienced traders, we are all well aware of the two types of options, call options and put options. We're also aware of a few key things like premiums, expiry, strike price, and more. However, to properly have a serious approach to options trading, you must adopt three practices: serious research, serious risk analysis, and serious discipline. This video will talk about what serious research entails when it comes to the options segment by breaking it into 6 bite-sized pointers. 1. Open interest built up. 2. Put call ratio or PCR. 3. Implied volatility or IV. 4. Volume weighted average price or VWAP. 5. Tools like bar charts, candlestick charts, and Dow theory. And 6. Position sizing. Remember, they apply to both options selling and options buying. Number 1. Open interest built up. This helps a trader understand the implications of short-term trends in the market better. Always check the open interest built up in the futures segment. This helps us form a view of whether the short-term trend is positive or negative. Long built up with an increase in volumes suggests an uptrend, whereas short built up with an increase in volume indicates a downtrend. 2. Put call ratio or PCR. This helps traders compare puts and call actions to understand the market sentiment. The put call ratio compares the number of open positions in put options versus call options to gauge market sentiment, and it has to be looked at from the hedging perspective. So, if there are more positions in puts than in calls, then it's bullish. So, open positions here are to be viewed not as a buyer of options but as a seller of an option. More positions in puts means more writing in puts, which is positive, and conversely with call options. Now, PCR of 1 is neutral for the markets. PCR above 1 is considered bullish, whereas PCR below 1 is considered bearish. The important point here is that PCR should be treated as an indicator which has formed a historical range. So PCR above 1.75 is considered as markets are overbought in the short term, whereas PCR below 0.5 is considered as markets are oversold in the short term. So PCR 1 up to 1.75 is bullish, and at 1.75 and above is overbought. Hence one can take a contra bet. 3. Implied volatility or IV. This is a way to assess and understand the market's view of the likelihood of change in the price of an options contract. IVs are used to price options, and higher IVs mean higher chances of changes in the price of a security, resulting in higher option premiums, and lower IVs mean lower chances of changes in the price of a security, resulting in lower options premium. 4. VWAP. This shows the average volume weighted price of a security's trades throughout the day and how its futures price can be a strong indicator of the market's trends. It indicates a price in the short term. So if the futures price of a security or commodity is trading above the VWAP, then the trend is positive. Traders can buy call options or sell put options. Conversely, if the futures price is trading below the VWAP, then traders can buy put options or sell call options. Number 5. A few key tools I'd like to mention are bar charts, candlestick charts, and Dow theory. These help a trader identify the underlying trend of the market or stock from a technical analysis standpoint to see whether the trend is bullish, bearish, or sideways, meaning no trend. Bar charts show the opening, closing, high, and low prices for each set period as a series of bars. Candlestick charts do the same but are color coded making it easier to see if the period was bullish or bearish. Dow theory helps a trader understand what positions are to be initiated. It divides the market into three broad trends: primary, secondary, and minor trends. So, if the market or a stock keeps making higher tops and doesn't fall below the previous bottoms, it suggests a bullish trend. On the other hand, if it keeps making lower tops and keeps falling below its previous bottoms, it indicates a bearish trend. So if the trend is bullish, one can buy a call option or sell a put option. Conversely, if the trend is bearish, one can buy a put option or write a call option. Lastly, number 6, position sizing. Position sizing in trading is deciding how much money you're going to risk on a single trade relative to your total trading capital. For example, using a 5% rule, if you have 1 lakh rupees, you'd risk no more than 5,000 rupees on any one trade. Each trader must develop a position sizing strategy that fits their risk tolerance and trading goals. This strategy guides you on how much to invest in a trade to control potential losses and maximize gains. Of course, there are other indicators as well that are helpful for options traders. However, these 6 are the most important and some of the more commonly used ones. Now we can clearly see why serious research is one of the most indispensable steps a trader should undertake. After all, it's our responsibility to learn about the different elements that can affect the price of an options contract and understand how to use them, thus maximizing our chances of success. Serious research forms the backbone of our journey into the world of options trading. Because here's the deal, options aren't shares, they're contracts with expiry dates and they demand your attention. Sure, they can amplify your gains, but you must be extra careful of losses as well. Getting into options without serious research is like trying to hit a bullseye blindfolded. So, before you even think about your next trade, stop, take a breath, and dive into the data. There are no shortcuts to success, but trust me, when you're informed, you're empowered, and that's when you can truly play the market to your advantage. If you're looking for a place to start, check out some educational resources. Sharekhan, for instance, has a ton of material to help you get a grip on the basics and beyond. So, to sum up this video, the 6 key elements of serious research in options trading are: 1. Open interest built up, 2. Put call ratio or PCR, 3. Implied volatility or IV, 4. Volume weighted average price or VWAP, 5. Tools like Dow theory, bar charts and candlestick charts, and 6. Position sizing. If you found this video helpful and want to learn more, remember to like, share and subscribe to our channel. We at Sharekhan believe in quality education through quality content. Leave your questions below and let's discuss them. Until next time, I wish you success in trading.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.